All right, everyone. In this video, we're going to take a look at AP 12B from the Chapter 9 homework workbook exercise problems. And in this problem, AP 12B, it gives us some transactions from this company AB Retailers. And so we're going to do some journal entries, and then we'll do some calculations of ending inventory. And then we have some information about what the potential doing a physical count and realizing that some of the inventory might have been stolen. Shrinkage, they call it, when inventory has just gone missing, not from a sale, right? So, okay, let's jump in here. Yeah, first thing I'm going to do, I'm just going to align these I had, and then I'll just do some of the formatting. Your copy, I don't think will need these exactly if you're working off the template here like I am. But if it does need it, I'm just center aligning the headers with our alignment button, then aligning these to the right in the accounting format, no decimals, and so on and so forth. So, okay, let's get started. So on April 10th, we bought, so we're going to have merchandise, inventory, asset increasing. We bought $3,500 worth of shirts, and the invoice showed payment terms of 210 net 30, so accounts payable. Again, we're going to indent because it's a credit. And this is from, so we'll say purchase, let's say inventory purchase, unique designers 210 net 30. Okay. And then on April 10th, it says, soon after we received the products, it was discovered that $500 worth of t-shirts did not meet quality standards, so we sent those back. And okay, I guess this happened on the same day. That was quick. I guess we bought them maybe at them directly from their store or something. It didn't ship it to us, and we didn't pay shipping, so I guess that makes sense. So basically, we talked about this previously. We're just reversing the earlier entry, so reversing the accounts. So our accounts payable now is going to go down, and inventory is going to go down. And we're going to say inventory return. We'll just leave the other information the same. I do like to italicize the explanations so they look a little different. But this was $500 worth. So AP went down by 500, and inventory went down by 500 as well. Okay, on the 20th, we paid the remaining invoice balance. So 420, we are paying cash, so our cash is going to go down, right? And we're paying off our accounts payable. Pretty basic accounting concept there. The one little trick on these, to keep in mind is that we originally had the first increase of payables of $3,500, but then it's going to be decreased by the next return that we had. So we only owed them $3,000 because we sent some of it back. So we have a $3,000 payment. Oh, and you know what? One thing I failed to do here. Let me add a space. So we can't forget, and I just did, and I just remembered that we have to account for the potential discount, right? So we paid within 10 days. We bought it on April 10th, and we had 10 days to receive our discount. So we paid on the last day possible to get the discount. So we always want to, whether it's accounts receivable or payable with the discount, we want to get rid of the payable in total. So 3,000 was the payable that was left over after the return. So we do that for the full amount. But cash is not going to be 3,000. We paid within the discount period, so we're only going to pay 98% of the total balance due, less the 2% that they're giving us for the discount. So we can say 98% times the amount that we owed them, which is $29.40. And then we need, oops, not a debit, but a credit. We need to show, whoops, we want that to be positive. We need to balance out, etc. And so we're going to reduce our merchandise inventory balance by the discount, because we actually ended up paying less for the inventory overall. So we credit the inventory balance to reduce it from its, originally it was 3,500. We sent back 500, so then it's 3,000, and then we reduced that value by 600 because we were able to take a discount and pay less for it. And let's say payment 410 purchase. Let's see. Let's abbreviate payment. I'm trying to figure out how to get that into space. 410 purchase, unique designers, yada yada yada. Oh, I spelled that wrong. Perfect. Okay. So that's good. Then what happened? On the 22nd, we sold all the goods for $4,500 to SK Stores on some, we have terms there. So let's go 422. So remember, if you've got this in your homework file there, you can go back and kind of, I guess don't steal the dates, but copy the entry over, because it's going to be very similar. And then we'll just do updates. So we sold it all to SK Stores. We have terms of 310 net 45. And yeah, same. All of the accounts we're going to be using are the same though. So 4,500, and it tells us that, okay, sold all of the goods. So we have to kind of figure out our cost of goods sold here. And we can do that by taking our, it's basically our inventory value at this point, right? Because we're selling all of the inventory. So remember, originally it was 3,500, but then we sent back 500, and then we took a discount for the 60. So it was basically what we were just talking about. So 2,940 is the full amount. And you can kind of match that up if you looked at what you actually ended up paying for it, would be another way to see that same thing. But we can also see just by going straight to the inventory account what the total was. And yeah, record cost of sales, SK Stores was our sale there. And if they pay us within 10 days, we're going to give them a 3% discount. And so then, lo and behold, they paid us on the 28th, so that is within the discount period. I'm going to copy this entry in, bring it down, and say 428. We got cash. Now this one's going to be, these are going to be a little different here. I'm just going to delete all this out. Okay, so this is on the 28th. So as I mentioned previously, we always want to get rid of all of our accounts receivable or payable whenever there's a payment or whenever there's a payment or a receipt. And so 4,500 is our total receivable, so that needs to go away in total. But remember that they did pay us within the discount period, so we're not going to collect the whole amount. Instead, we're only going to collect 97%, which is less the 3% discount that they took. And I'm going to actually take this, or you know what, let's do it like this. But instead of payment, let's change this to receipt, and we'll say this was the 422 sale, and it was to SK Stores, and it was 310 net 35. So just kind of update some of those. And then, so again, we're collecting less cash. So the difference then that we need to consider is $135. And this is again where we're going to use that contra revenue account called sales discounts. And then the other one, remember, was sales returns and allowances is the other contra account that we can potentially utilize if we have some returns or allowances. Okay, so that's all the transactions through the dates here that are provided. And it asks us in part B to calculate April's ending inventory based on the above transactions. Assume that merchandise inventory at the beginning of April amounted to $1,500. So right off the bat, I'm going to walk through this calculation because I think it's valuable. But do remember that it just told us that we sold all of our inventory that we purchased. So if we know the beginning value was 15 and then we bought some inventory but we sold it all, I think you could pretty logically deduce that you're going to have $1,500 of inventory still in inventory if you sold all the stuff you purchased during the month. But let's look at it. I'm going to put that currency there and just kind of put the pieces together. So all of our purchases, like we said, we bought, or we had the 3,500 was our purchase. This stretch that out a little bit. One thing you'll see sometimes in accounting and how I like to set this up when you have a table like this, where it's a table format, is like if it's dollar signs, let's just do it all in accounting format. We don't want decimal places. And let's put dollar. Sometimes you'll see dollar signs just on the top and the bottom of a table, and then everything between it. If you see dollar signs at the top and bottom, you can assume that everything between is dollars also. So that's just something to keep in mind. But we had purchases, beginning inventory, it tells us 1,500. We had purchases of 3,500. That was that time. We had returns, so we'll subtract that, of 500. Then we had a discount of 60, right? That was because we paid within the discount period. And then our cost of goods sold, is inventory that left the door, basically. It went out the building, right? And so if we take all those together, we get back to 1,500. So like I said, it told us that we sold out of all of our inventory during the month that we purchased. So you can kind of reasonably deduce that we'd get back to our beginning amount. But this is kind of a nice way to sort of see what that would be. And if you wanted to put it in like a T account format here, I just created this little T account, and we can see that we had 1,500 to start, then we had the 3,500, then we had the 500 credit, 50 credit again, and then when we had our sale, we had 29.40, and whoops, I think I just put those on there. Purchases 3,500. Sorry, 500. I'm not sure if I did that right. 60 on the credit, and then inventory 29.40. I think I just put that on the wrong side. So if you were actually journalizing or posting our journals to the ledger, this is what you'd see, the T account kind of style. So you take your debits and credits, which is the same thing as this table. Basically, it's going to get us to the same place. But if we want to see it in our debit and credit format, then you got your debits are larger than your credits, so you end up with 1,500. So debits and credits version, plus and minus version, and this is just the journal entries here is the same thing essentially. Okay, last part. At the end of April, an inventory count was performed, and the balance of inventory according to the count was 1,300. We thought it was supposed to be 1,500, right, from what we just did, but it's actually we actually counted physically and see, wait, there's only $1,300 worth of inventory. And we deem that the difference is due to theft. Some employee or someone walked in off the street or something, and they stole some of that inventory. And so we need to make a journal entry to adjust the inventory balance, because we don't want to show 1,500 if you actually go out there and count and there's only 1,300, right? So we need to figure out what do we do with that difference of $200. Well, what we do, and this was on April 30th, so we'll put our date in there. It's going to align those in the center. And we're going to decrease the inventory. That's kind of obvious because this is the adjustment. We need our inventory to be 1,300 at the end of the month, because that's what it actually is. When you went out and looked, we can't say it's 1,500 because it's not. Somehow it disappeared, not through a sale. Sorry, I'm just doing some spell check here. Okay. So that's pretty obvious that we'd want to credit the merchandise inventory count. If it was in our we were doing this up here and showing it on our T account at this point, we would then, credit our inventory account for 200 to bring it down to actual of 1300, which is what we counted. And the expense account that we're going to use is cost of goods sold. And you could theoretically have a specific account to track inventory shrinkage, but for our purposes here, we'll say to adjust inventory to count. So this is just saying like we counted, it was less, and we adjusted. And so we're just writing down the asset, and we're going to increase our cost of goods sold to account for the fact that we ended up with $1,300 balance basically. So, and like I said, there's other ways you could theoretically do that. You could track the shrinkage in its own account to, as another different expense account that would kind of go alongside cost of goods sold. But in this version here, and one common technique, just putting it to cost of goods sold. So, okay, well, that's AP 12B. Thanks for watching the video, and I will see you in the next one where we'll finish up the Chapter 9 workbook exercises with AP 20B. All right, thanks, everybody.